Hello and welcome to Livewire Markets. My name is Chris Conway. Today I'm having a chat with Catriona Burns from Wilson Asset Management. Catriona has more than 20 years of experience in the Australian and global share markets, and she's going to be sharing with us where she's seeing risks and opportunities in today's volatile markets. Catriona, thanks so much for sitting down with Livewire. It's great to see you.
Nice to see you, Chris. Thanks for having me.
Catriona, there's been so much already happened at the start of this year. We're only just clicked over into our second month. There's lots going on. I just wanted to get your perspective. We've just come out of US earnings season, but what are the 2 or 3 most important themes or factors that you're watching in global markets, and how are they influencing how you invest?
Yeah, thanks, Chris. It's been an interesting start to the 2026 calendar year, and actually the first, even the fiscal year, second half calendar year of last year was really interesting in terms of stocks that were winning and what was working. It was very much factor led rather than earnings led, I think, in a lot of ways for when you looked at share prices. So you had companies where the earnings were actually, very strong, but they were sold off indiscriminately just because they were in, the wrong area, whether that be, deemed an AI loser, or, materials and resources had a very strong run, gold had a very strong run. And you had, some very high quality businesses, I think, that, where the earnings are actually compounding really well, but were just indiscriminately sold off. So it's a fascinating market at the moment. And, for us, throwing up lots of opportunities. And yes, so opportunity rich. I think, ultimately for us, it'll be earnings that drive share prices. But at the moment, it's been very factor led. And when you look at, what's worked, it has been sort of unprofitable companies outperforming profitable. You've got momentum working, volatility working. So very factor led rather than earnings led.
Catriona, I'm sure we'll dive deeper into it as we go through the rest of the conversation, but I did just want to ask there, when markets aren't necessarily behaving the way that you think they will or they have historically, and it's factor driven, as you were just talking about, what's the best way to approach it? This is really a question for the investors at home. Is it going back to your core disciplines and, like you said, focusing on valuations, focusing on all the things that over the long term will drive good share price performance and good returns? Is that the key?
Yeah, absolutely. And, we have a very clear process in terms of the sort of companies that we're looking to invest in. We do have a quality bias. We're looking for great businesses that have very high quality management teams, strong industry positions, earnings growth, strong earnings growth potential, and then that valuation overlay. None of that has really mattered very much in the last sort of 6 to 9 months, but I think ultimately, staying true to your process and finding high quality businesses, with profitability, with structural tailwinds, etc. Ultimately, is the key. And environments like now, you do find lots of opportunities. So I think, yeah, absolutely, that's for us what we're doing right now.
Catriona, we saw the RBA hike rates in Australia earlier in the week. It's potentially a different story that we'll see in the US throughout 2026, where rate cuts are expected. So I just wanted to get your base case for global equities as we move through 2026.
Yeah, it's very interesting with the appointment of Kevin Warsh in the US as the new Fed chair, who'll be coming in May. He's made a lot of comments around, cutting rates, which, and has probably got him into the seat, which because Trump's very much on that push as well. So that is the expectation for the short end of the curve. What will be interesting is, how that plays out. He's also made comments around wanting to shrink the Fed's balance sheet, but that's going to be particularly difficult, it looks like, when you've got Trump also pushing for the GSEs to purchase mortgage-backed securities. So we think there's a bit of a dynamic there in terms of it does look like we'll get some interest rate cuts in the US, but at the same time, his ability to shrink the Fed's balance sheet is pretty questionable at this point. And Scott Bessent has had the same comments historically, and not been actually it's going the other way. That backdrop is actually supportive for global equities and US equities as we look through this year. Also, the backdrop for the US economy is actually pretty strong right now. You've had, if we looked back back to a year ago, there was all the tariff noise, and then Liberation Day, obviously in April. But a year on, you're seeing the recent, the manufacturing ISM prints actually very strong. We'll see what services do today. But actually, the backdrop for the US economy has been very strong. You've got, a fiscal stimulus and a government that's, very supportive of spend going into the midterm elections in November. You've got potentially those interest rate cuts. So the backdrop for us for economic growth is actually still remains pretty solid. So that's a good backdrop for equities. It'll be super interesting, though, within equities, what actually works, because at the moment, whether it's deciding in AI that software's a loser but hardware's a winner, there's been a massive factor for driving markets. As I said earlier, underlying things like gold have done extremely well. So it'll be more interesting what happens below the surface than the headline, but the more the bigger backdrop in terms of economic growth, particularly in the US, looking decent, is supportive of equity markets. And then when you look further around the world, say Europe, where you've got governments in places like Germany that are more supportive of spend, is positive, even though the overall outlook for growth isn't particularly impressive. We do think even in places like that there are fundamental stories where stocks have very strong earnings backdrops, whether you're exposed to that infrastructure pickup in infrastructure spend or defense spend. We do think there's opportunities in other places, but the US backdrop for growth is particularly decent as we look through the first half. That's probably it. I mean, there's obviously always risk to that.
That was literally my next question, Catriona. So I was going to hone in specifically on, is inflation the biggest risks to the whole scenario? And then, equally, what are some of the other risks that you're seeing? Yeah.
That will be a key watch point as we go through the year, the inflation numbers. And I think that'll be very interesting to watch for what Walsh does. Obviously, he's only one of the members for the central bank, but he, has got himself in some ways a little captured by saying he will cut rates. But it'll be interesting if you see inflation tick up, what the Fed actually does. And if, because right now we are pricing in cuts, and if you saw that come out, that'll be again, which stocks work under that scenario. And you could, under that scenario, see one of the areas that's been really thrown out is quality in general. Quality stocks have been under pressure, and you would, under that scenario, be very likely to see, a move back to companies that have pricing power, quality overlays would start to work under that environment. I think that'll be the probably, this as we go into the second half of the calendar year, will be something to certainly watch.
Dive a little bit deeper into how the portfolio is set up now, where you're leaning in, and then equally, Catriona, what are you leaning away from at the moment?
We've got a reasonably well diversified portfolio. Why I say reasonably is we tend to hunt, as I said, in that equality space. So we don't tend to, invest in, say, biotechs or resources companies where the company can't control the macro and a commodity price, etc. So it's with that lens. But then, when I look across the exposures, we've got, high quality names across business services. We own various exchanges. We own within AI, we own some software, some hardware. And then we play in the healthcare space. We love, innovative health is a really exciting area, we think, right now. And where, AI is actually speeding up the pace of innovation in healthcare. So we've got plays there. So we think we've got, a diversified portfolio of really high quality businesses. And we're continuing. And what's happening at the moment, as I said, with, say, in particular in that AI space, where the market is shooting first with, okay, this is a loser, this is a winner. We saw the same when GLP-1s came into the market, and there was a lot of okay, every snack company is dead, every medical tech company, that we think that is happening at the moment in AI. So we're seeing a lot of opportunities from that kind of throw the baby out with the bathwater attitude. So we think we're taking advantage there, but we are, diversified, as I said, across a really high quality bunch of businesses, and being opportunistic.
Catriona, you've just shared how you're thinking about the world that you're investing in. Can you talk me through a couple of the stocks that you're liking right now, whether it be strong performers from the last year or even a name that you've added to the portfolio more recently?
A couple of contributors to performance have been companies like Thermo Fisher Scientific, and another would be Quanta Services. Thermo Fisher Scientific is basically picks and shovels to the medical, healthcare industry. They do things, medical equipment, instruments, consumables. They don't care which biotech or which large pharma company wins. They just sell to everyone in terms of the tools and equipment and provide services to these companies. And as I said, in terms of AI, the pace of innovation in the healthcare space and disease identification, genetic sequencing, etc., is all speeding up dramatically. And we think Thermo Fisher Scientific is really well placed to benefit. It was a company where we've owned it, traded around in it because of the volatility around COVID. It was a massive beneficiary of obviously the pandemic and all the spend that went into healthcare and vaccinations, etc. at that time. Then had an overhang as lots of companies had overstocked with supplies, and then there was a bit of there was that overhang that had to be worked through. And we think we're on the other side of that, and AI, as I said, is starting to speed up innovation in the medical arena and going to really benefit them going forward. So it's been a contributor, and we think we're really excited about the outlook there for that business. And another one would be Quanta, which I've talked about a bit in the past, which is we bought actually during COVID and have continued to hold ever since. They do transmission and electrical grid upgrades across the US grid. And at the time, the thesis was, okay, we're all working from home. The use of, whether it's us, now on a virtual call, or the grid just being extremely aged and needing upgrades. This was a company that was continuing to operate and actually grow through coming out of COVID. It actually demand picked up. What's subsequently overlaid onto that story of massive investment in the US grid has now been all the massive investment in data centers and bringing, hooking up the grid, bringing all the capacity online to enable us to drive the best efficiencies out of AI. And so they've got what is already a great underlying story in terms of upgrading the US grid is now being overlaid with AI demand and bringing data centers on. So that's another one we continue to hold and like. In terms of a new stock, we are starting to add some new positions in that really sold off software space. An example of that would be Scout24, which is like the REA of Germany. We've owned it in the past and then had exited, but we've started to make our way back into a position there, just because actually, when you look across, whether it's Australia or the rest of the world, all their classifieds businesses are apparently dead. So we think that's a really exciting opportunity. Clearly, you got to wait. You want to be slowly entering because they're still getting whacked even overnight. You saw the divergence between AI considered winners and losers, continue on. But we think the high quality management team, industry position that is extremely strong. Dominant. These are dominant marketplace businesses, and where you've got strong earnings growth potential as they add on incremental products, as they continue to premiumize. So that's an idea. That's an example of a stock that we're adding more recently.
Catriona, last question. What advice would you have for investors playing at home trying to navigate this market as we move through 2026?
I think you've got to concentrate and focus on earnings growth. Like eventually we will get to a point where the market refocuses on earnings. And if a company can consistently grow, compound earnings, you've got a rational management team that is, even taking advantage, like doing buybacks into current weakness, then ultimately earnings will drive share prices. And then we overlay that at WAM with identifying a catalyst that we think will drive the share price. But I think ultimately we'll get back in periods of like this where you're seeing perhaps it's factor led rather than earnings led. Ultimately, you do see that we do get back to a focus on earnings driving share prices, and I think be opportunistic where you've got confidence in the earnings of a business over time.
Catriona, thanks so much for sitting down with Livewire. Appreciate you sharing your insights.
Thanks, Chris.
If you enjoyed that interview, make sure to give it a like and don't forget to follow our YouTube channel. We're adding lots of great content every single week.